Hi, I'm Jimmy. In this video, we're going to look at a few key stock market price indicators to see if we can figure out how overvalued the stock market is right now. We're going to use the Warren Buffett Indicator, we're going to use the standard price to earnings ratio, and then we're going to also look at the Shiller price to earnings ratio. Okay, so let's dive into this thing. First up, we have the Warren Buffett Indicator. So the Buffett Indicator basically takes the stock market cap. For that, we're using the Wilshire 5000, the market cap of that to represent the market cap of the total stock market. And then we divide that by the gross domestic product of the United States. So the theory here is that it totally makes sense for the stock market to move higher as long as the gross domestic product, or GDP, continues to move higher. Now, if the stock market gets too high relative to the size of GDP, well, we know in theory that the stock market is becoming overvalued. Now, this at least partially explains this crazy high spike right now, since GDP has continued to struggle during the coronavirus, yet the stock market has somehow continued to push and break all-time highs. So according to this metric, yes, the stock market is overvalued right now. Okay, now let's shift over to the more common price to earnings multiple for the S&P 500. Once again, we are at an extremely high level right now relative to the history of the price to earnings ratio for the S&P 500. Right now, the PE ratio for the S&P 500 is about 30 times earnings, or 30 times profit. So clearly, this is quite high. In fact, it's the highest level since the tech bubble of 1999-2000. Now, if we're curious, the average PE throughout this entire time period, and for this we're going all the way back to 1955, well, the average PE is about 17 times earnings. So in theory, we want to look at the stock market and say, hey, it's about 17x. That implies it's about fairly valued. Now, I do think it might be important for us to look at this and say, maybe it doesn't make sense to go all the way back to 1955. And here's why. The interest rate for the broader economy, the one that's set by the Federal Reserve, and I know, yes, many people look at that and say they're manipulating the market. And in many cases, that's true. But with lower interest rates, well, stock prices should be higher. So now we can add, this is the 10-year Treasury yield. So what is the yield on the 10-year Treasury going back the past few years? In this case, I could find data going back to 1962. So that's how far back I went. Now, I lined the time up on these two charts, but just to set some scale to this, at the beginning of this time period, well, that red line was about 4%. And then when interest rates peaked back here in early 1981, I believe it was, well, that was about almost 16%. It was like 15.75%. And then just recently, well, we're talking 0.5%. Okay, so loosely speaking, when interest rates are crazy high, well, it's logical that investors would be less inclined to invest in the stock market, and therefore, broadly speaking, the PE ratio of the S&P 500 should be lower. That's what we see here. So, if we were to consider the fact that interest rates today are at one of the lowest levels in history, well, this would in fact imply that more people are going to be investing in the stock market because they have to have a place to earn it. You can't really earn interest in banks. There's not a lot of good money in bonds. So investing in the stock market is logical. Plus, you're going to have a lower required rate of return. So higher stock prices does make some sense. With that being said, I still think 30x is way too high. Frankly, personally, I think it should be closer to 20, 22, maybe 23, 24. I could justify. I would feel more comfortable if it was closer to 20, maybe 22. Given how low interest rates are. Now, I also think it's important that we recognize the fact that many of the recent spikes that we've seen in the S&P 500, in the PE of the S&P 500, happen during the big recessions. So if we look at the tech bubble, we look at the current coronavirus issue, well, that makes sense because as companies begin to lose pricing power, or their earnings begin to fall essentially, well, the stock market, which is a very forward-looking being, begins to predict when that's going to end. Now, I think that's one of the things that's happened with the coronavirus, is that outside of the Fed jumping in, I think people have looked, well, this is going to go away quicker. And as they do, investors keep sort of running up the prices. And now I think it's gone too far. But the reason why I bring that out is I'm not sure it makes sense during the tech bubble, after the market already crashed, to say, well, because the PE ratio was that high, that was in fact a bad thing for the overall stock market. We would probably be wise to invest at that point. When the recession, the financial crisis happened, of 2008, 2009, well, investing when things fell, even if the PE multiple spiked, it could still make sense. So we shouldn't lean too heavily on this. And with that being said, let's look at another metric. So now we have the Shiller PE ratio. Now what the Shiller PE ratio does is it takes average earnings over a period of time and adjusts it for inflation. So in theory, what we're going to end up with is, let's say a company is growing because they're not really growing their revenue that much or their profits that much. They're just keeping up with inflation. Well, that's not a very good company. So earnings would look, using this method, like they've stalled out. And if the price kept rising, well, that company would look more and more overvalued, which is very logical. So basically, we're accounting for the fact that inflation should increase revenue. It should increase profits. We take that out of the equation, and this is the multiple we end up. And we can see that once again, the Shiller PE ratio, just like the other two ratios, are up near one of the highest levels in history. We can see that this chart goes all the way back to 1901, and the current level of the Shiller PE ratio is about 34 times inflation-adjusted earnings. Now, that's about the same level as it was back in the Great Depression of 1929. So that's a bit crazy. Of course, the tech bubble here, the real high spike, well, that's the highest level. And that one was a bit different because that was sort of a mania where many companies were priced crazy, crazy high and they had no profits at all, many of them. So obviously that's somewhat of a unique situation. Now we should also point out that just like we talked about the regular PE ratio, well, that also applies here, how the regular PE ratio is adjusted, or not adjusted, but you should account for interest rates in that whole thing. If we look at the late 70s and early 80s here, well, we can see once again, the numbers look excessively low here, but that's because interest rates and also inflation back then was at a much higher level than it is today. So combine those two, you end up with a much lower PE ratio, or a Shiller PE ratio back then. So at the end of the day, the Shiller PE ratio is up near all-time highs. The traditional PE ratio is also up near all-time highs. The Buffett indicator is also up near all-time highs. All signs are pointing to this stock market being fairly well overvalued at this point. Like I said, I think it's 30% too high, maybe 25% too high, but still high enough that I'm aware of it, and I think we should all be wary of it. So does it make sense to avoid investing at this point? Well, I don't think that's a terribly smart thing to do, and anybody who's been following this channel for a while knows that I've recently been getting involved in different companies, individual companies that appear to be a good value when I jump into them. Just because it's overvalued right now, who's to say the stock market doesn't go another 10 or 20% higher? Who's to say this doesn't get run out for another couple of years? Now, with that being said, I do think that it makes sense to be smart about how we're investing. That's what I'm trying to do personally, trying to find individual companies that could do very well. I would spend as much time as we can trying to find great investments, even if it's not an individual company. Maybe it's an ETF, maybe it's electric vehicles, or some sort of robotics ETF, or something that we believe is good for the future. Now, if we can find great buy and hold stocks or ETFs or whatever the investment is, to me, that makes the most sense. Now, I would be more hesitant about investing on margin. Now, if you're not 100% sure about, you might have heard about margin and get the basics of it, but if you're not 100% sure about what margin is and how the impacts of investing on margin, what it could do to your account, well, I actually did an animation video where I go through some of the basics of margin and how they work and how it can impact your overall investing experience. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.